What we're really seeing again, as I said before, is what's in the documents. And now you can specify when redemption takes place. If you're looking at distressed assets, when you get out, when you can't get out, there'll be a date when you switch from being a shareholder to a creditor, which makes things rather different. The one unusual thing in Cayman came about as a change in the insolvency law in terms of giving remedies to investors. And unusually in Cayman, a contingent creditor can actually petition to wind up a fund. So it may be that you actually really want to force the hand of the fund, you're not happy to sit there for a while. But as soon as you put in a redemption request now, that makes you a contingent creditor, because upon your redemption taking place, you'll become a creditor.
Right.
And unusually under Cayman law, that gives you a right to petition to wind up the whole company, bring the fund to an end, and put a liquidator in, so it's not the manager running the assets anymore.
Right.
The other thing we've seen clients doing a lot, and I'll be interested in the other panel members' views on this, is they're starting to now just dish out in specie. So giving illiquid lumps of assets to investors who haven't the slightest idea what to do with them. I mean, if there's anything really good to do with them, the manager would have done it. So really just passing on the problem. And the other problem, which was referred to earlier, side pockets, which came originally for slightly different reasons, but have now expanded hugely to cover a whole range of problems. They aren't a solution to everything, but they do, sort of, from the manager's point of view, put the problem off for a while.
Yeah, yeah. Before we get into the problems, and in more detail perhaps, and what more investors can do and what the potential solutions are, can we just establish, and we obviously it's already been referred to by Graham, by me, the situation that occurred during the credit crisis and as being the turning point, but fascinating comment I think that Mark made. It's the consequence of a general lack of leverage in the business of the fund of funds, which I didn't realise until you said that, is perhaps one of the major causes of this, over and beyond what's gone on in the markets. And are you therefore saying, because no one's expecting any return to the leverage situation that we had a few years ago anytime soon, if anything it could even get worse from what I understand, are you saying if that's the situation, then the problem that we're here to discuss this afternoon could go on and get worse in the future, even if you're in a strategy that in some respects isn't doing too badly, or in a fund that isn't doing too badly?
No, not necessarily. I think the withdrawal of leverage has forced fund-of-fund businesses to re-examine their business model. And I think one of the mistakes that investors made if they used fund-of-funds to access the hedge fund market was to rely on the fund-of-funds to provide liquidity for assets which are fundamentally illiquid. You cannot turn
That's a good point. Yeah.
a sow's ear into a silk purse is the usual expression, and the way that a lot of this liquidity was provided by fund of funds, or seemingly provided, was the access to leverage, which allowed them to smooth out the process of investing and redeeming from underlying hedge funds assets. That no longer being available makes it much more difficult for them to provide that level of liquidity without maintaining a significant cash balance, which reduces their ability to make returns, and therefore they have problems justifying the fee that they would charge in this process. So I think the fund-of-fund business will still be around. I think it becomes much more of a ongoing due diligence and risk management business, and they will need to re-examine the way that they charge their fees. But the fact that leverage has been withdrawn, I think, isn't going to necessarily make the problem any worse, because I think the leverage has gone now. To a large extent, the leverage has gone and won't return for a long time. But the issue is that investors are all correlated. That the tendency is that when some investors start to come out, a lot of investors start to come out. And the initial trigger about 2 years ago of that leverage being withdrawn caused a number of redemptions, which caused a follow-on series of redemptions. That process is more or less run its course now, and you are left with the illiquid positions in the portfolio that are getting harder and harder to realise.
Okay, I'd like to thank you for that sort of overall explanation of where we are, which I found very interesting. But now let's really focus upon what can and should be done. John, can you hear me? Okay. What is it that, can you describe a little bit about the work that you're doing and in practical terms, what is it, and there are investors listening to this webcast or watching this webcast, can we just go through what are the options if they find themselves in a situation that obviously a number of them are in today, what are the options open to them if they want to get access to those distressed hedge fund assets that are in the side pocket or whatever it is? If someone could just run down what the options are.
If I may start first with the comment that the first order of business is to determine whether the value of one side pocket is what the manager says it is, and to understand what that valuation methodology used by the manager, and then determine whether or not you believe it's the correct one. The issue is more severe for institutional investors in the United States. It's been several years that the Department of Labor has pressured all ERISA plans with the responsibility that they are not allowed to accept the manager's valuation of their illiquid investments. They have to go and independently value it themselves. So institutional investors, certainly in the public pension world, understand this. It's important that other investors that are non-ERISA also understand that they need to independently value the worth of their side pocket. Once that's done, then you're able to make a judgment as to whether the alternatives of, as outlined by Mark earlier, using the secondary market with the brokers, or going direct through to the manager himself and asking for an auction, etc. If those alternatives are done, and then at what price you can deal at and liquidate your investment. And that's the kind of process that one has to go through, and then make the determination whether I sell for example, 40 cents on the dollar, or whether I believe the valuation is going to be higher and I keep it in the portfolio.
Okay.
Well, can I just sort of comment on that? One of the problems that we experience is that, especially with the managers that we're dealing with now, there can be a number of issues about getting sufficient information about a side pocket asset or a portfolio of assets underlying a single strategy hedge fund to enable an investor to do a proper due diligence on what those shares should be or what those assets should be worth. And the key issue is that individual investors who turn up at the manager's door quite often get fobbed off with insufficient information to be able to form a view about the underlying valuation. And it is a continuing problem with dealing with the remaining assets.
Yeah, if I may follow up on that, we make sure that potential buyers sign an NDA with the manager in question. And there have been instances where the manager refuses to allow that, in which case the possibility of selling that side pocket is null because of potential lawsuits if one discloses information that one has agreed not to. So you really need the cooperation of the manager, and if there is no cooperation, then you run up against a brick wall against which the only alternative is going to court and suing for the liquidation of that fund, which is a different story.
Well, this is why Gray's here to a certain extent, if not to a large extent. How often does that happen?
The thing you have to bear in mind is that legally you're not actually entitled to much transparency in terms of the underlying investments of a hedge fund. The whole transparency talk, you forget, is actually fairly new to the industry. It's been talked about so much in recent months, we forget that 2-3 years ago it was talked about far less, when people receiving 20-30%, they didn't really care too much what the underlying assets were. So in terms of going to manager saying, I demand to know what the underlying assets, in most cases the manager is fully entitled to say, no, I'm not going to tell you. Whether that's a good way of investor relations or not is a separate question. They're also faced with a difficult situation in that what they will be told by their lawyers the whole time is that they have to treat all shareholders the same. So if someone comes along demanding information, they've got to take that as a request from everybody to know everything that's happening with their fund. So while they might be happy to deal with an individual buyer of assets or whatever it may be, their concern is that they'll put them in a better position than all their other shareholders, and so they're going to have to tell everybody everything that's going on, which they may well not want to do. So that does lead, as has just been said, to people going to court, because that is the way that you will actually get disclosure of everything that's going on underneath.
Yeah. Now I can see why it's such a boon for your business.
Yeah, and I would go back to the second option that I talked about at the beginning. Rather than selling, you can also aggregate these positions. So if investors largely speak with a single voice, then they are much more likely to get traction with an investment manager about disclosure of information. So if they are disclosing information to hopefully a majority of investors, and there can be a focal point through which this information is disseminated to investors, which is controlled by someone other than the manager, that may be an effective tool to allowing investors to have the transparency that they want. But they will not get that if they sit there and do nothing.
Yeah.
Simon, I want to add, as far as the hedge funds that have U.S. GP and LP structures, they're required, if they meet certain size criteria, they'll be registered with the SEC. And as people know, in the last 6 months, we've had at least 3 cases where the SEC has filed fraud charges on side pockets. The most recent one being against Palisades Master Fund, which had created a side pocket equal to 20% of the fund's NAV, and whose side pocket, according to the SEC filing, was inflated by a factor of 10. We also have the example last summer of Southbridge Capital, and also Plainfield Asset earlier, which was a whistleblower case. And in 2 of the instances, Palisades and Southbridge, the fraud charges centered around the overvaluation of pipes in the side pocket, pipes being private investments in public equities. So, of course, pipes are a particular kind of security that is very susceptible to overvaluation, but I do point that out.
It's worth pointing out as well, if you're considering side pockets, that what happens with fees, management fees and performance fees with return to side pockets, because it does vary hugely and it can change the motivation. Originally, funds, when they're set up as side pockets, fees tended to be suspended in respect of assets that were in side pockets and were caught up when it went back into the main fund or were distributed. But as time's gone on, we've actually seen things have changed, and now a valuation is placed on, or the last valuation, whatever may be used. So there's actually an incentive on managers to keep those going, because they are still getting management fees on that asset value. So in terms of working out where you are and what the manager wants, whether he's getting any fees on these may come into play.
And that, that reinforces the point about valuation that we touched upon earlier. Unless you can get an accurate valuation, there is every chance that a manager will set values in his own interest to increase his fee take and also provide him with working capital to keep his business alive. Investors need to be very cautious about that and need to monitor that very carefully.